Hello and welcome to our latest Money Show Money Masters podcast segment. I'm Mike Larson, editor-in-chief at MoneyShow, and today I'm speaking with Ken Mahoney, president and CEO of Mahoney Asset Management. Ken, welcome to the podcast.
Hey, great to be here. Love the work that you do, Mike, and I just can't wait to dig in and share some ideas in this really difficult market, that's for sure.
Yeah, no kidding, right? I appreciate that. And we're definitely going to get to talking about the market in a minute. Just to give you some, or give our viewers some background. I mean, you've been a financial advisor for more than 3 decades. You've written, I think, what is it, 9 books on investing and retirement.
Can't get that 10th one, Mike. It just hasn't come to me yet, so I'm stuck at 9.
And you speak on television, the radio all the time about the market. So why don't you start by talking a little bit about your methodology, your GPS method for financial planning, and how that works?
Right, so the GPS for financial planning is more about from 30,000 feet that we don't do a lot. We're always trying to catch the next trade and so forth. Is look at where your expenses will be in retirement, all the kind of financial planning one-on-one, but we call it GPS to kind of navigate you. Hey, where your expenses are going to be, how they can increase over time with inflation, how you're going to combat that with Social Security, pensions, retirement money, and so forth, and use different projections on what your returns might be. And we do a little Monte Carlo simulation with those some probabilities and stats. And as far as my methodology, as far as picking stock or stock selection, I'm a disciple of William O'Neill, a very happy one over many years. William O'Neill, as we know, passed away a few months, God rest his soul. But he brought a whole army of disciples from his great work, How to Make Money in Stocks, that 4th edition book, the Orange Book, as well as the founder of Investor Business Daily. So a lot of my work centers around the great work that he has done.
Perfect. Okay. That gives people a little bit of a background here, just so they know where they're coming at if they're not familiar with your work. So sure. With that said, let's shift to the big story or the big picture view of this environment. I mean, big first half rally, noteworthy 2-month correction. What do you see coming next? What's driving this action?
Look, it's all been about interest rates. It's been the seesaw effect from last year, the Federal Reserve getting behind the curve and raising rates and all the disruption that caused last year's bear market. This year, we had a great summer, June, July, blistering hot, probably where you live, but also blistering hot markets. And then August was a thud. That started off, remember, with U.S. debt being downgraded by Fitch. That led to higher interest rates. And the next leg down was pretty much a week ago, again, centering around interest rates. Federal Reserve Chair kind of saying we're going to keep rates higher for longer. That offers competition to stocks. And we've been reeling since that. Wednesday, Thursday, we've been just a difficult time for investors, to say the least. I'm hoping, by the way, there's a catalyst here somewhere. I knew coming in September, September could be tricky. It has that adage and lived up to its name. But going forward, I'm hoping that big tech delivers third, fourth week in October from the September 30th, quarter end, and we get kind of limping into earnings. Expectations are low, and hopefully we can go back to their leadership once again, the Apple's, Microsoft, and so forth.
Gotcha. Yeah, I think on a segment with Maria Bartiromo, you called September Nowhere Land or something like that. And I think
we're like Nowhere's Land. It's like not a good place to be. Meaning, raise some cash, keep your powder dry, let the stocks come to you. And the only catalyst we had was the Federal Reserve, and that turned into be a different type of catalyst, a catalyst for more selling.
Let's talk a little bit about that. We've been in this sort of rising dollar, rising rate dynamic for the last, 2 months, give or take. And that was the kind of environment that we had in 2022 that gave us such a hard time. Do you think we're going to go back to that? Do you think this is more of just sort of an echo of that and not be that severe? I'm kind of curious as to your take on that front.
Right. I mean, look, we've been telling clients now for a few months that I believe we're in the 8th or 9th inning of the rate hike cycle. And it looks like we may get some extra innings here. And that's what the market's not liking. Kind of like, okay, we can live with a 5 1/4, 5 1/2, but can we live with 6 1/4? Can we live 6 1/2? I don't think so. I think, rates offer much competition to stocks. So, it is all data dependent. It's kind of like good news is bad news scenario. Again, good news for the economy is not good because it means the Federal Reserve is going to raise rates. They left the door wide open. And actually, the expectation somewhere, I don't know why, but sometime next year, they'll be cutting rates. Again, that's not in our little crystal ball. We don't see that happening. And now he reconfirmed that, or they reconfirmed that, in fact, most likely they're going to keep these rates higher for longer to make sure they really squash down inflation.
Now, you mentioned squashing inflation. That's obviously what they're looking to do. I mean, there's been all this talk, inverted yield curve, recession risk, and blah, blah, blah. I mean, do you put a lot of stock into that? Or do you think that what we're seeing now is kind of a confirmation the economy is going to ride through this okay, and that's why we're talking about higher for longer?
I think so. Let's go back to January this year. Everybody had on their bingo card that we're going to have a hard landing. The only question is, are we going to lose the cockpit? Are we going to lose the fin? Are we going to use the tail? Whatever these different components on the airplane is. And, that's what everybody's talking about. And meanwhile, here we are with these higher interest rates, and somehow even the housing market's holding up with higher rates. And the market's been holding up with higher rates because we do know we are in the eighth or ninth inning. We may stay there for some time, but the worst of the rate hikes is behind us in 22. But by all means, economists had it way wrong. The resiliency of this economy, even with higher rates.
Let's move on a little bit to what that means for markets, right? I mean, you've been a big believer all year in sort of big tech, the AI-driven story, and so on. Obviously, those kinds of companies, when you raise the cost of money, it tends to impact growth names like those most. Where do you think we stand? Do you still think that's a great longer-term story?
I do. I think the companies need technology. We all live as consumers. Businesses need B2B, need all these services and so forth. And you kind of think about it. It's really how can I say? It's really the haves and have-nots, a tale of two markets: technology market and everything else. Do you want to be in airlines? No, I think you could short those probably. Autos? No, you probably short those. Retailers like Macy's is one of our best short ideas. Sometimes we do pair trades, but in the end here, I do think the technology will resume leadership, and I think that can happen around earnings season if they can give investors good guidance. As when we come out earnings, it's really what they did that quarter. We really need to know going forward what the guidance is. So technology can come back and give us good guidance. There's excitement about AI. We get the train back on the rails again. If not, we'll have chop out to the rest of the year.
And I think one of the other sectors you talked about recently was energy. I mean, obviously, we're all looking at what's happening at the pumps, prices going up again. There's chatter about $100 oil. What do you see going on there and some of the big oil names, Exxon's, for example?
Yeah, so a lot of times if we're going to direct money into oil, we use the ETF IYE, so they get Exxon, Chevron, a 3.5% dividend. We're actually one of those kind of maybe contrarians on purpose, but every time we got down to $70 a barrel, who would come along? Saudis, and say, nope, we're going to cut 1 million barrels. And then, we gravitate towards 75, 78, back towards 70, and here comes Saudi. So I feel like investors feel there's a put there somewhere in the low 70s. And again, when it comes risk reward, anytime you feel there's a put, you get aggressive to the upside. I don't believe in some of these numbers coming out 150 a gallon, so 150 a barrel and that type of stuff. So again, we've already made most of the trade. Actually, if anything, we're actually nibbling on some of those profits right now out of oil because it's already made a tremendous move from 70 to $96 a barrel. Yeah, there could be a little bit more in there, but thankfully we got in pretty early on that particular.
Anything else, sector-wise or even individual name that you're really pretty, bullish on here? And conversely, I guess anything that you really think investors need to be avoiding?
Right. So we're still very bullish on Microsoft. I mean, the stock is treated poorly. If you look at a chart, you would say, Mahoney, I mean, we're charted. What are you looking at? Well, I'm not looking at the chart, but I am kind of thinking of like Microsoft, you call it a stock, you associate a number to it. But if you think Microsoft as a business and owning part of that business, I mean, look at all the verticals they have. I mean, it goes on and on from cloud to gaming to internet security, to the software platform. Oh, let's wrap AI into the cloud and get accretive earnings there. So again, I think some of these companies have taken it way too hard, and Apple would stick up there too. I know the campaign perhaps in the new iPhone 15 rollout wasn't all that dramatic, but there too, you're finding it off at least 10, 12% off its highs. These are the go-to. Come on, Apple has 2 billion, that's a lot of users out there that have phones in their hand. They could do a lot of good things with 2 billion customers.
Anything, when it comes to other asset classes, I mean, obviously with interest rates rising, at some point you got to step in and be a buyer of bonds for yield, for example. I mean, what are your thoughts on that? Anything you want to say there, or even some of the other things that have been impacted, like precious metals?
Yeah, and really overlooked area of the bond market, I would say, is closed-end funds. Closed-end funds trade many times because of this, turn upside down market and interest rates and so forth. You're finding a lot of these closed-end funds trading 10, 15, 20% below net asset value. So if you buy a bond fund, typical bond fund, XYZ bond fund, you're buying it at net asset value, okay? I prefer 10, 20% discount. Doesn't mean that has to make up that 10, 20%. They could trade like that for eternity at 10, 20% discount. But having a choice between buying a bond fund at net asset value or some of these many of these closed-end funds that are trading 10, 15, 20% below net asset value, I would rather take that path.
We're about a month out now from the Orlando Money Show. And obviously people are going to get a chance to hear what you have to say there. Any kind of sneak peek without giving away too much as to what you're going to be talking about? I know theoretically your topic is some of the best investing and trading strategies. I know that sometimes that can change between now and the event.
Well, Mike, I love that it's October 31st. I'm definitely going to wear some type of costume. Maybe I'll put myself as an asset manager. So my little preview, I guess, to October 31st and Halloween is around tactics. We spend so much time, doing scans and coming up with different stock ideas and so forth, and charts and so forth. But once you're in that stock, I really want to go into a lot of sell discipline. When do we sell that stock? When do we add more to that stock? Some of the nitty gritty that, again, often we can't do in TV segments because we have to kind of go very fast. But take that time and go through tactics with those who show up. And I think they're going to have a really good time with this. And as well, start really kind of navigating towards that area where the tactical, I believe, is going to make a big difference. Those little dots that connect things together, when you add, when you sell, all those type of things I will cover at that segment.
Ken, I do appreciate you taking some time out here. Thank you so much for the insights. Viewers, listeners, if you do want to hear more from Ken and dozens of other top financial experts, market experts, economists, all that, do check out the Money Show Traders Expo Orlando. You'll find details in the link below. We're scheduled for October 29th to 31st at the Omni Orlando Resort at Champions Gate. And one last thing, if you like this video and you learned something here, don't forget to hit the like and subscribe buttons. Ken, thank you so much for your time. I look forward to seeing you next month in Orlando.
Can't wait.